Good day, everybody, and welcome to Cartesian Talks. I can't believe this is our fifth one already. Time certainly is flying, but I think it's also because every time we have these talks, Anthea joins us with a new special guest that adds an interesting element and that really helps us in making money. And today will be no exception. Anthea needs no introduction. She's the smart asset manager that does a million other things and whose main aim is to help us make money. She is also the person that knows just about everybody in the country and perhaps even the world. And so she makes sure that we get an interesting guest every time. And we're joined today by Stephán Engelbrecht. And I'm going to introduce him a bit better and fuller later because he's got an MBA, he's a CFA, he's got a degree in financial maths and a whole bunch of other stuff. But most importantly, I think Anthea's asked Stephán to join us because some of your Twitter followers were upset that there were women in short shorts, Anthea, and said they would prefer men. So I think Stephán is busy wearing a hoodie at the moment, but maybe Anthea is going to have him in shorts by the end of the webinar. So Anthea, we're talking about shorting stocks and hedge funds, and we are really looking forward to you unpacking this for us. I must agree with, I think it was Quenza on the Twitter, who also just said she hopes that you have remembered your graphs. So please tell me that you haven't disappointed us, that you've got your graphs, and that you are ready to blow us away. Over to you, Anthea.
Oh, let me put that on. Good morning. Thank you very much, Carl. Before I start, I actually just want to say a huge thank you to you, Carl, and your team at CN&CO. I just really love working with professional people. And I've actually had some of our regular audience show appreciation that these webinars are now CPD approved. So thank you, Llewellyn, for doing that for us. And happy lockdown birthday as well, Llewellyn. Right, so as is my reputation, I'm going to see if I can share there we go. Sorry, for a minute there, I thought I'd lost some of my sharing screen abilities. There we go. Right, so let's kick off with a graph of the all-share index for the last 20 years. And really, there is nothing to explain here. As you can see, over the long term, the stock market has without question been a good moneymaker. But we also know it's not all listed companies have covered themselves in glory. So here's a graph of the Steinhoff share price over the same 20-year period. What they say about a picture painting 1,000 words really is true. I might have to add or include adages in my repertoire of skills, but let's move on. We don't even have to be that dramatic, like using Steinhoff. What about that retail business we all know and love that first opened their doors in Plain Street in Cape Town in a dining room of the Royal Hotel all the way back in 1931? So Over the same 20-year period, it has yielded a positive return, not particularly exciting, because in the last 4 years, it seems they've made a few big mistakes and the market really has punished them for it. So the question is, what is an investor to do? And when you think a share is going to increase in value, you can buy the share. If the share does increase in value, you make a profit. So basically, a little bit of maths, I mean, just as an example, if you bought a share at 100 Rand next week, which was up to 120, you've made a profit of 20 Rand, right? If the share price goes down next week to 80 Rand, you've made a loss of 20 Rand. If you're selling shares or going short, as we say, and the price today is 100 Rand, next week it's 120 Rand, you've made a loss of 20 Rand. If next week the share goes down to 80 Rand, you've obviously made a profit if you've shorted the share. So as for buying shares, selling or shorting shares, as we call it, the reverse in fact works. So you can actually even sell shares when you don't own them. All you have to do is actually borrow the share. So this mathematics is fairly simple, and it's going to get a little bit complicated now when I show you what the risk profile looks like. This is the risk profile of going long a share. So let's say you buy the share at 100 Rand, where the little black dot is. On the left-hand side of that quadrant, if the share falls, let's say to 80 Rand, you've lost, let me get my pointer, you've lost 20 Rand. If it falls to 60 Rand, you've lost 40 Rand. If the share goes up, and I know this seems a bit obvious actually, but if let's say the share goes up to 120, you've made a profit of 20 Rand, and so forth, all the way up and up and up. And we've seen some things like the Naspers share price where this dotted line feels sometimes like it's infinite. This is going to take a bit more concentration. So this is what happens when you short a share. On the vertical axis, we've got the share price. On the horizontal axis, we've got your profit and loss. If you buy the share at 100, and the share, my apologies, I must be careful here. If you sell the share, you're going short the share at 100, and to the right, the share price falls to 50, your profit is 50 Rand, right? You got that. So you've sold the share at 100, the share falls to 50, and your profit is 50 Rand. So in other words, when you are taking profit on a long position, as the share price increases, you are, what we're saying, you've got a book profit, right? The minute you sell that share, that's when you realize this profit. So you've bought the share at 100, you sell it at 150, you've actually made, or you've actualized your profit of 50 Rand. It's the same theory. So when you are short a share, and at 100, and the share price falls to 50, the minute you buy back that share, because don't forget you've sold it, you make, or you realize your profit of 50 Rand. Here's the important thing about going short shares. If the share price increases, and as you can see, my vertical axis, your profit and loss, let's say the share price goes to 50, your loss, if you are short the share, is 50 Rand. And so it goes until you keep, and when you are buying a share and the share falls, look on the right-hand side, to 0, that's about as far as the share can fall. And so your loss, or sorry, your profit, in fact, is, no, I've got this the wrong way around, my apologies. If you are buying a share and it falls to 0, that is the maximum you can lose, because the share can't fall to negative territory. If you are shorting a share, all this long and short is confusing, but if you are shorting a share, the problem is that the share can actually travel up and up. The share price can go as high as it wishes. And every uptick in the share price is in fact a loss-making position to the person who has shorted or sold the share. Sure, that's quite a bit to deal with. And on top of all of that, when you short a share, you don't actually own the share. So you do, in fact, have to borrow the share from someone first, and there is a charge for that. And depending on how much liquidity or how many people are willing to lend you their shares that they own, depends on what the cost of the borrow will be. Then, if the original owner or lender of the share wants to sell, she will recall her borrow, the lend that she's given to you, the loan she's made to you, and you have to give her back her shares, which means you then have to go and buy back the shares so that you can give her back her shares. Inevitably, I'm afraid, this borrow or this recall, as we call it, often happens at a less than optimal timing. So I want to take you back to what initiated the topic for this webinar, that very charismatic South African-born entrepreneur, Elon Musk. So have a look at the share price over the last 5 years. Hold in your minds for a few minutes the share price in Tesla over the last year and see how it has traveled. Arrive on the scene a guy called David Einhorn, a hedge fund manager who became famous making a lot of money after shorting Lehman Brothers in 2007 before they went bankrupt, before the bank went bankrupt. Einhorn has described Tesla as a fraud and has been holding a short position in the share since 2017. And as you can see from the first graph, it hasn't gone very well for him. I mean, David Einhorn is founder and president of Greenlight Capital, which is a hedge fund. I love Americans. Like, they have such great titles. When I was working for Morgan Stanley, I was a vice president. I mean, that's a very cool title. David Einhorn also wrote a book called Fooling Some of the People All of the Time, a long, short, and now complete story. I think the now complete is the updated version of his story. He describes himself as a hedge fund manager, and then says the majority give him a strange look, and then he quickly adds, I'm a money manager. And when that strange look persists, as it often does, he corrects it by simply saying, I am an investor. Everyone knows what that is. Definitely everyone on this webinar knows what that is. Stage left Elon Musk and his I don't take myself too seriously attitude. He manufactured and sold Tesla shorts, of course, sending a pair to Einhorn. Notice the Tesla models on the back of the shorts, and I'm not talking about the skinny woman in the shorts. I'm talking about the Tesla models. So some people don't know this, but Elon Musk has named his cars Model S, Model 3, the Tesla Model X, and the Tesla Model Y. Of course, not ignoring Elon's very adult references in the price of his shorts, specifically being $69.420. So yeah, luckily though, we are protected from ourselves. Hedge fund investments are for qualified investors or people with a net worth over $1 billion. And so I get that this topic is often not for just retail investors, but hopefully we'll see some interest. So before I hand over to Stephán, I just wanted to say that I'm old enough to remember the dot-com bubble. And I'm wondering really, Stephán, if this time is different. You know, Tesla is now worth more as a company than Toyota, even though it produces, 4% of Toyota's total manufacturing. The share trades at an eye-watering ratio. It has a larger-than-life CEO. Admittedly, I like his confidence and his charisma, but come on. Even he's admitted to smoking something. So, Stephán, what do you think? Should we be following Musk or taking our cue from David Einhorn, sorry.
Sorry, I was just on mute there. Oh, it's such a tough question. I mean, every fiber in my body says that Tesla is probably one of the biggest shorts currently in the market. But there's a saying for when you want to buy a share, never try and catch a falling piano, where if a share just goes down and down and down, don't try and buy the Stein off. And it's similar with shorts. Don't stand in front of the locomotive. So I will definitely not buy it, but it's one of those stocks that's one that you don't really want to sell because it is currently a locomotive and it's got a lot of momentum. But it feels very reminiscent to the dot-com bubble. I'm actually working on a bit of a piece now, the anatomy of a bubble. Just going through all the stuff that creates a bubble. And I mean, we are in the perfect environment at present to create bubbles in global assets.
Sorry, Stephán, when you say we, oh, you mean global assets, not just South Africa, right? I mean, there's such a huge dislocation between what's happening on the ground in South Africa. I mean, yesterday, Kieswetter was saying that 30,000 companies have gone into business rescue, and yet our stock market the JSE is back at levels like pre-COVID.
Yeah. But it's very similar to a lot of other issues that we've had. I mean, if you think about what you need for a bubble, you need a crisis so that there are free money available across the world. So if you think of the dot-com bubble, the one most recently, that was preceded by the emerging market debt crisis. The financial system pumped money, saved a lot of these assets, and there were a lot of money available. You need a good story. So the Y2K story during the dot-com bubble, currently we believe that the whole world is just going to stay in a pandemic for the rest of our lives, and Amazon, Tesla, and all of these things are going to be the only companies left at the end of the world after this pandemic, and we're only going to buy on Amazon. So you need a good story as well. And then the final thing is when people start to convince themselves that this time it is different, and they move higher and higher up the income statement to justify the valuation. So in normal times, you look at the earnings. Then you probably get a little bit more excited, and you move to the EBIT level of the earnings before interest and tax. Then you move a little bit higher, and you go to the gross profit margin or the gross profit. And we're now at the stage where we're now trying to justify the valuation of these tech companies on the sales level. In the dot-com phase, we started to get to price per click type of valuation methodologies. And I think we are not too far away from, because I've started seeing price by eyeballs on some of these valuations. So listen, the one thing we must remember is during a bubble, a lot of money can be made, so don't shy away. These companies are brilliant companies. Don't go and sell all of your stocks. It can last for a lot longer than you may think. And a lot of clever people are going to convince you to stay in there, and that probably means that these stocks may rally further. But we must just be eyes wide open and be aware of what we're going into.
Okay, thank you.
That's quite a long-winded answer to your very short question. Sorry about that.
It was a great answer, so no apologies needed. So I think, Stephán, we're going to go over to your presentation, and then Anthea and I are going to ask some tough questions, because you've definitely had it far too easy. So
perfect. Let me just try. I always get this wrong. Let me just get this right here and share. There you go.
Perfect.
Okay, fantastic. Well, firstly, thank you very much for the invite. I'm really honored to be in here on this webinar. I always love talking about the markets, shorting, and I love it when people show interest in this. And I really hope that you guys can get some value out of this presentation. And yeah, if you have any questions, please either let me know at the end of the presentation, or pop us an email, and we're more than happy to reply to them. Okay, so the theme here that Anthea asked me to talk about is shorting, but also more importantly, I think Anthea has gone through the complex world of shorting with you guys, and she broke it down quite nicely. but she asked me just to take it a little bit further and to give you guys context on where shorting or how hedge funds that are the main users of shorts actually use it in their portfolio. And I think it's very important to know how hedge funds try to use it, because a short is not, as Anthea highlighted, a short is not the same as a long. And I will never suggest to any private individual or private investor to have a single short in their portfolio, because as Anthea highlighted, the maximum profit that you can make in a short is 100%. So you can basically double your money. That's if you get a Steinhoff or a African bank. But those scenarios are actually quite rare. It's always better rather to be long. The markets, although it doesn't feel that way, but historically speaking, the markets are basically in a bull market 70% of the time, which means it's going up 70% of the time, and 30% of the time it goes down. So the odds are always in your favor to rather be long than short. But having said that, shorts do provide a very specific role in a hedge fund portfolio. And that is what I would like to discuss with you guys. So what are the various roles that shorts can play in a portfolio? Firstly, and most importantly, it's a source of funding. So what do I mean by this? Basically, let's take a very simple scenario for a transaction that I think probably everybody on this webinar has either considered or probably has done in the past. Let's say you buy a house and you go and take out a mortgage to fund this house. Now, your view, let's assume it's only financial and there is no other benefits like living in your house and stuff like that you need to consider. It's purely a financial transaction. Your view when you take out that mortgage is that the price or the value of the house is going to increase by more than your mortgage rate over the period of time that you pay your mortgage. So in other words, if you believe that your house is going to grow by less than 5%, let's use prime at the moment, let's say you're a prime candidate, so it's a 7.25% currently. Let's hope it goes a little bit lower this afternoon. So if you believe that your house is going to appreciate in value by less than 7.25%, it's a very bad investment to buy a house with debt, because you're actually going to lose money. Your funding costs are higher than the house appreciation cost. Now, you've actually created a short there. You bought your house and you went short of your mortgage. So basically, you got the money from your mortgage and you have to repay it later on throughout your career. You could alternatively, and once again, I'm not advising anybody to do this, predominantly because of tax reasons. The tax consequences can be quite severe here. If you believe that the stock market is completely overvalued, you can go and short the market, and you will get money in your bank account for the amount that you've shorted, and you can use that to buy your house. Your view then is basically that your house will appreciate more than the stock market will appreciate in value. So instead of paying or having to pay back at the mortgage rate, 7.25%, you will then have to basically repay whatever the stock market did over the same period. So that is basically the way hedge fund managers look at shorting. It's a source of funding. So when we believe that a share price is going to appreciate by less than the borrowing cost, which is approximately 6%, then we believe that it's better to rather use a short in a share to fund an acquisition of a share in another price. So it's always a relative play. It's always looking at where we think we can optimize our funding cost for our portfolio. And that's the critical thing that we always evaluate. And that's why quite often hedge fund managers don't look at the share price performance on an absolute level of our short portfolio, but rather on a relative basis, and especially relative to the borrowing cost. Because if we believe that the borrowing costs are too low, we can rather just go and borrow money and use that money to invest in shares and basically gear ourselves in that way. However, sometimes share price performances can be lower than the borrowing cost. On to the next one is the profit center. That is if you have the Steinhoff, the African bank, where you have a very high conviction view that a stock is overvalued and that the share price is going to fall and you're going to make an absolute profit. However, this, as I mentioned earlier, is actually quite rare. If you look at historically, as I mentioned earlier, stock markets tend to go up 70% of the time. So shares over time tend to appreciate in value. It's only very specific examples of either companies being taking too much leverage onto their balance sheet, well, complete corruption, which is actually a little bit more difficult to identify, or where they're just getting completely disintermediated by new technology, where you really get a point where the share prices will fall in absolute value. So although this is the one where everybody talks about, this is the fun one that everybody will brag about, these are actually quite seldom. And in any effect, I don't quite enjoy talking too much about this, because for every short where you make money, you know that there are millions more people that are losing money because they are long of that share. So it's not one that I take a lot of pleasure out of in a short portfolio. This is then also a very key reason why we use shorts, and that is to hedge out a specific risk for a long position. Now, let's take a very simple example. Let's assume that we like MTN, but we like MTN not because of their South African exposure. In fact, we are quite worried. I'm not saying this is our base case at the moment. I'm just using an example that you guys can be familiar with. We like MTN not because of their South African exposure, but because of their global exposure in Africa and in the Middle East. We believe that it's too cheap and that there will be greater growth in these areas. However, we are reasonably concerned about what's happening on the legislative front in South Africa, and especially with the delay in releasing spectrum in South Africa, which can be a deterrent to growth. So we're worried about South Africa. We're excited about the rest of the business. Then we will try and find a proxy for MTN's South African business, which in this example, you have quite an easy one, and that's Vodacom. So we say that this is a real risk for MTN. However, because of if that real risk is materialized, then Vodacom will be impacted by this to the same extent, if not greater than MTN. So then we will go long of MTN, and we'll buy MTN, and we will have a short position in Vodacom, where it has a bigger percentage of the South African market, and it is much more of a South African proxy than an MTN. So by having that position, if, for example, we would then expect, if the market, if something was to happen in South Africa and the spectrum auction, something strange happens to that, and the market takes a negative view on what's happening in South Africa, Vodacom will go down by 30%, because it will get impacted more severely if there's something negative in South Africa. And we expect MTN to also go down, but it will only go down by, say, 15%. Having the relative trade on, then we will still make 15% of that in that trade. So we will be positive 15% because Vodacom went down 30. We made 30, let's say we had 100 Rand in both. We made 30 Rand on the Vodacom short, but we lost 15 Rand in MTN, which means we still have a net profit of 15 Rand. And there are numerous examples like this. So for example, an Exara Resources, which has a lot of coal business, but it also has a big position in iron ore, Kumba iron ore. So if we are worried about our Kumba position, we just want exposed to the coal position, we will buy Exara and short Kumba iron ore against that. And so I can have quite a few examples like that. So it's just to hedge out a specific risk that we're worried about for a stock by using a proxy for that specific risk. And then finally, and this is probably the most boring one, but it is quite relevant, is that if we are, by going short, we do get some market protection. So if you get a scenario, like for example, in March and late Feb, where the entire market just starts to go down, if you have a short position in some stocks, your portfolio tends to be more protected than if you were only long of the market. So because you will have some stocks going up or down, you will make a lower loss or less of a loss than a stock that's only, or a unit trust that's only invested on the long side. So it just reduces the volatility of the overall portfolio. So almost an additional source of diversification for your portfolio. But that is a very crude way of doing it. I believe there are other ways to be more, to protect yourself from market movements in a more efficient way, but shorting does provide that for the hedge fund managers as well. But most importantly, in the end, is shorts have a role to play in a portfolio, as I just explained to you guys. And it's just like a Formula One pit crew. Every single one of those guys that's currently there, having to change the tire, lift the car, refuel in the good old days when you actually still had refueling. These guys all have one specific role, and it's only when they work together as a team when they're able to do this within less than 10 seconds. That's the same way in portfolio construction. Shorting has a very specific role in a portfolio construction, and each one of those roles are critical. And I will never be willing to tell you guys that this is a short that I have in the portfolio. I think that must be your entire portfolio, or just put it into your portfolio because we think you can make money out of that. Because the position that it has in the construction of the portfolio is very specific and tailor-made for the portfolio. And that is why shorting is very much more of a portfolio construction than on an absolute sense. And I think that is it from me, guys.
Thanks very much, Stephán. As I said in the beginning, I was going to introduce you a bit more properly, apart from all your impressive degrees. But I mean, normally your day job is head of equity research at Anchor, and you've been in the SA equity market since early 2000s. And before I let Anthea loose on you with her difficult questions, what's been the most spectacular short that you've experienced?
As I say, I prefer not to talk too much about shorting, because I'm fully aware that if you make money out of shorts, there tend to be more people that lost money than those who made it. But we were quite short of African Bank. That was one that really worked well for us. And then happily over that period as well, we were in a fortunate position to buy Capitec, because we just realized that the market was just having a broad brush stroke and saying that everybody that had micro lending or short unsecured lending in the South African market were the same. And it was quite clear to us that it wasn't that way. So we had quite a big long Capitec short African Bank. Capitec at that stage was about 150, 160 Rand. An African bank was at about 40 Rand. So that was one of those that really just worked out perfectly.
Mm. So thanks. I think you've explained that really well. And for me, what I find fascinating, apart from that, this seminar, I really have to work hard to earn my CPD hour. But you and Anthea are keeping us on our toes. Is I think as a retail investor, one must be careful to use shorting as part of your portfolio, because then you're in the danger of trading territory. And you've explained that a hedge fund manager really uses shorting very differently than a trader would, and that for me was really interesting.
Yeah, and I think, I mean, that's once again where Hollywood plays, or Hollywood and the media in general is I think a little bit guilty here in making that Big Short movie, although it was a fantastic movie. It glorified shorts. You lose, as a hedge fund manager, I can tell you that I lose money mostly on my shorts. And I'm fully aware of the fact that I'm losing money, but it's relative to the other costs, the opportunity cost of doing something else, where shorting really starts to provide value to a portfolio manager. So forgetting about tax treatment, because remember, shorting has very severe tax treatment for a retail investor. I will never say that you must use shorting in your retail portfolio. It's a very specific role that it plays for a hedge fund manager, and that's why you pay management fees to a hedge fund manager, rather, if you would like that type of exposure in your portfolio.
Thanks. Anthea, back to you. I'm interested if you can help us with some of the terminology. So we had floating around a short squeeze. And what is that? There's fantastic terminology that Stephán and Jörg use in this world. So tell us, short squeeze.
I know this is a difficult webinar, a difficult topic, right? And I've tried very hard not to use kind of this jargon that we use in our industry, but I guess we can't get away from some of it. You're right, we're earning our CPD points. So a short squeeze is not a quick hug. And I alluded to it earlier on when I said, when you are going to short shares, you need to borrow them. So I'm going to give you an example. Let me just think about this for a second. Let's say I was long Tesla shares. And so in my portfolio, I hold Tesla shares. You, Carl, decide, actually, no, you're on David Einhorn's side. You want to short these shares. You think that's going down and you want to make money like that. Because you don't own the shares, you come to me, you borrow the shares from me. I then watch this thing tick up a little bit and think, well, actually, I've made enough money now. I need to take profit on my long position. So I want to sell the shares that I have. But because I've loaned them to you, who shorted the share, and by the way, making a loss, I actually have to recall my shares from you, or my borrow from you, insist. And so it is my prerogative, actually, because I'm the lender, to say to you, Carl, it's time, I want my shares back. The shares traveled up, you then have to go and buy these shares in the market so that you can give them back to me. And as you're buying, that momentum of you buying shares invariably pushes the share higher. And so what you see is, when people have shorted, when there's a huge short position on a share, like for example Tesla, and these recalls start coming in, and the sellers or the people who have shorted the share are forced to go buy the share and push the share even higher, that's what we call a short squeeze. Great,
thank you. We've got a couple of questions around resources and learning and gaining experience, and I'm interested to ask both you and Stephán what it is that you do to be able to arrive at the decisions that you make. Because I think, particularly for newer investors, but I've had experience with people that have invested for a long time, they think it's very glamorous. So they only see you make a quick call, Stephán, basically just has a cup of coffee, couple of drinks during the day, swans around, plucks a share from a hat, makes some cash, and that's it. Same with you, Anthea. Host a webinar, come up with a name. But I mean, it's not, I think actually your industry and your job is very unglamorous. So in terms of research and getting experience, what do you do? Where does it come from?
feel like I want to answer this for Stephán. Because, you know, so when you start out in this industry, and as you say, it really is like, oh, that's exciting. They're buying and selling and they're on the stock market and shares. And, you know, we go on TV and we talk about it and we're on webinars and, oh, it's very exciting. Talk about Tesla and Amazon and Jeff Bezos. And it's all very exciting, but actually it's not. So Steph, I can give you, if you don't mind, Stephán, a rundown of your day. But basically, when you start in the industry, you spend years just building spreadsheets, massive spreadsheets, analytical spreadsheets, looking at the companies and understanding companies' balance sheets, their income statements, understanding what drives companies, their market, the macroeconomic environment. Like, it's not at all glamorous. There are years of behind all of this ability to go, okay, right, well, I think I'm not going to short Tesla, but I don't like it, as Stephán said earlier on, so I'm not going to buy it either. I mean, that's years of understanding what pushes a share price higher, how a company is valued, whether it's over or undervalued. So yeah, I'm sorry to disillusion you, but it's really not that glamorous. As for resources about where to go, very, very difficult question. I mean, I really would recommend, you know, ensuring that your majority of your money is professionally managed. So through your pension fund, through your retirement annuity, again, speak to your financial advisor, please. And then I don't see why you shouldn't have a little play around in the stock market, but don't make it 100%, or don't even make it 50, or don't even make it 80% of your portfolio. You know, kind of you take some money and read. You have to read every single day. All I do all day is have CNBC or Business Day running in the background on TV, and my Bloomberg screen, my Iris system, you know, reading all the research that comes from all the analysts, either in our team or from the banks where we get research. So yeah, it's research, research, research.
Stephán, anything you'd like to add to that? Well, you read. That is what I do. I spend my day reading. And I mean, it is fun. It's great. You're doing research all the time. You have to go and find out about the industry. You have to go and find out about the company. You have to go and analyze their strategy. But it's all about reading, research, and looking at the longer term view of the company. I'm completely other way around from Anthea. I don't think I've watched CNBC or Bloomberg or any one of those news channels in years. I just feel these days they are more noise than real news. So I just try to stay away from them. And you rather go and you look at the real fundamental drivers of a company, and to make sure that your feet stay grounded and you don't get hyped up in whatever the most recent thing in the market that's pushing share prices higher or lower. Rather just read the real fundamentals of what's happening in the market and make sure that you make your investments on that stage. And that's excluding all the Excel models that Anthea said. But I mean, you tend to do that in about your first 3 or 4 years, and then you just update them over time. Now it's just about reading and to make sure that you understand the business well. So Anthea, go for it, Anthea, before I ask you.
I was going to say the other thing that Stephán pointed out without actually saying the words is that if you're an investor, you really should be a long-term investor. You know, traders are the guys who go in for a day or two and they sit in front of their screens and they're watching the share price move up and down. But if you're a real investor, you kind of understand the company really well. You buy your share and hold it, kind of have a bit of conviction in the research you've done and your decision to own, or in this case, to short a share.
Yeah, and I think that was also interesting in Stephán's presentation in terms of the percentages in terms of long and shorting, the likelihood of making money. And Anthea, I do think we've got a responsibility in this industry to be clear. Trading is not investing, and whilst you can make a tremendous amount of money in trading, you can also make a tremendous amount of money at the casino. But you can also make a tremendous loss at the casino, and investing is different. So I want to ask you, particularly Anthea, but also Stephán, in a South African context, and not now just during the pandemic, do companies do a good job in giving you enough information to arrive at your decisions? So yes, you're doing the reading. Yes, you're listening to TV. Yes, you're getting information from a bank. But are companies good enough in how they report, how they engage, or not?
I would say that not all companies are created equal or report or have equal investor relations. Another part of kind of your research, especially as an equity analyst, is actually going to meet management and understanding their strategy in the business, understanding who they are. I mean, I think, you know, what really springs to mind when you ask me that question is Marcus Jooste from Steinhoff. So it was interesting to be in presentations with him because he was just so bold and so brave and confident and like dead sure that he was doing the right thing and actually quite convincing almost. But when you spoke to him, there was always this little tiny gut feeling you had about, you know, and people would ask questions. And so I think what I'm trying to say is that if you are an investor and analyzing a company, you need to be objective. And I understand that through the years, as Steinhoff's share price just kept rallying, even if you had followed your gut, or I should say, if you had followed your gut, you would have lost money, right? Because Steinhoff just kept going, and then in the end, it all came out. And so you will learn as an investor how to be objective and how to critically think about what you're doing. So there's more at play here than just your fundamental analysis. So what we do is we build a spreadsheet and we go, oh, that's my target price, because if they make X amount in earnings, if their profit margins continue increasing in this way, then next year the company will be worth X, of course, basing it on PE ratios and exit valuations and all that. But there's also a part of kind of, I think it really is kind of experience when you're analyzing or investing, where you have to consider that you are investing against a whole lot of other people. So if you sit at Steinhoff and go, oh, you know what, I actually don't like this share, and I think it's all going to come crashing down, but the market doesn't have the same view as you, you will lose money. So there's kind of two ways of looking at it. Do companies do enough? I think investor relations and, in fact, even AGMs and results presentations are actually marketing for a company. You know, it's where the company goes and says, look at us, we're really great. These are our results. Look how well we've done. But it's up to the investor to critically think about how to digest that information.
Thanks. Stephán, do you want to add anything before I ask you a question from one of our regulars, Elma?
Yeah, I think just to quickly just re-emphasize what Anthea said. Absolutely, when a company isn't out there to tell you the bad news. They are marketing themselves. They want their share price to go up. Management tend to be incentivized in share options. So they don't want their share price to go down. They will always try to tell you the good story. So it is important for an investor to think critically about stocks and about companies, but also to always be aware that don't just go and try and find the Steinhoff in every single company. Every single company is not a fraud. If you keep on thinking like that, you will miss all of the great companies as well. So think about it critically, but be aware that you don't always just go and find the Ponzi scheme.
Mm. One of the questions relates to as an investor, can you just ask a company for their statements? And the short answer is absolutely. And as a shareholder, you have a right to go to AGMs. There is nothing that you can't ask. And I think more and more investors need to understand that. Go to AGMs, ask the questions, find the information. It's not only your right, it will help you make better decisions. So Elma, there's a question. Stephán, there's a question from Elma around the Viceroy report on Capitec, and your view whether that was malice, intended strategy on their part, or were there legitimate concerns? And I mean, Viceroy aren't the only people that are, have been criticized of perhaps intentionally playing with the share price. But yeah, your views.
Yeah, I mean, I hate the business model of Viceroy. I'm all for companies like that to be critical of companies and to do strong and very critical research. But the way Viceroy goes about it to make it such a big deal and to glamorize the shorting, I'm very concerned about that, especially if it's on a bank where you can actually be, it's almost a self-fulfilling prophecy when they start to do that. However, on the Viceroy, specifically pertaining to Capitec, I mean, it was a ridiculous report. If you started going through the report and to read through it, there was absolutely no grounds for, let's say, 80% of what they're saying. 20% is a concern for Capitec, where we are worried about how exactly do they do the what do they call it, curing of loans, which basically means that if you have to repay your loan and you can't repay your loan, they'll give you another loan to almost repay that loan, but they then just extend your term. So that's the one where the market and us to some extent just need more and more information. But since that Viceroy report, we have to give credit to Capitec. They have been very clear and gave us a lot of information on that. And we're a lot more comfortable now. But I mean, half of their thing was based on a lawsuit, that a civil claim that they believe that South African consumers were going to lodge against Capitec and basically going to get the company to go bankrupt. And there's never been in South Africa ever a civil claim close to that. So it was just a very bad report, written probably in bad faith, because they had a short position in Capitec. They made money and they closed that short position about 2 weeks later. So it was really bad. And once again that's why it's important not to get too caught up in the media. I got so angry at the media of South Africa giving Viceroy such a lot of attention. It was really dangerous for South Africa, and I'm very pleased that the Reserve Bank reacted the way they did.
Can I interject for a second? Just because Stephán mentioned the Viceroy model, I kind of want to impress upon our audience that I often get asked for what is my stock pick of the day or week or month or whatever it is. And I think this whole idea that we manage money, we have a very carefully curated portfolio of shares and bonds and whatever it is, just for me to say, well, actually, I've gone long MTN, so I think you should all be buying MTN. It's pretty much what Viceroy did, right? They said, well, we've got a short position, and so we think you should all be selling it because the momentum of you all selling the share will, in fact, drive the share lower, making money for us. So again, this kind of critical thinking is so crucial for being an investor.
Good point. And also just listening to Stephán and Anthea, I think the challenge that I'm going to give you is, do you know anybody that is not direct? Because every time you have a guest on, there is no subtlety. They go straight for the jugular. So clearly that's your go-to default. Anthea and Stephán, we've spoken largely around equity, so shares in shorting. A couple of questions around things like gold, oil, Forex. And I think people sort of get a little bit confused, but maybe a word or two from you, Anthea, around that.
So you could basically short anything where you can borrow in the market. That's probably kind of the key. Forex is slightly different because you're playing one against the other. So actually what you are doing is always going long and short. So when you buy the South African rand versus the US dollar, in fact, you're saying that you think the rand will strengthen and the US dollar will weaken. So kind of, it's not an obvious short position, I'm borrowing a share and selling it. But I'm absolutely going to leave Stephán to answer the question about gold, because he did a great presentation in our investment meeting a couple of weeks ago, last week maybe even, about buying and selling gold.
And now's the time. So I think that's actually a good intro with where gold is at, Stephán.
Thanks, Anthea. I was not quite prepared for this one. I thought we were talking about shorting. But anyway, just quickly answering that. I mean, Anthea made such a good point just now that Forex is always a long-short position. So people must always remember that you are actually always going in short positions. When you buy US assets, for example, in a South African, in a Rand portfolio, you are technically short of the Rand. So that is an interesting way of looking at it. On gold, I will definitely not be shorting it at this stage. The whole discussion that we had right at the beginning of this presentation of the interesting environment that we're currently finding ourselves in, with loose monetary policy, a crisis that we've just gone through. It really is a scenario where you're ticking all the boxes for a very good environment for gold. I'm not inherently a gold bull. In fact, I've never been a gold bull. I really don't like the metal. I think it's almost, I mean, it's the equivalent of a Bitcoin. Because, I mean, you don't actually earn anything of it. It's got value because it's got value. There is no real fundamental dividends or income stream that you can derive from gold. But going into economic theory and why there is gold and what the role that gold plays in a portfolio, which is protection against a dollar depreciation in the dollar, protection against inflation, which usually comes when you have loose monetary policy, and also market corrections. You really get a perfect storm currently for gold, in theory, to go higher. But once again, that is only theory. Gold in practice doesn't have any value really. So if you buy gold, have it a small portion of your portfolio. Be aware that you are buying something that doesn't actually have inherent value. So go into the position eyes wide open, but theoretically it is the perfect environment for it.
I'm very biased, but that was a brilliant answer, Stephán. So thank you. Anthea, as we near the end, we started off with your graph, so thank you. And we're going to end off with another Antheism, which you've already alluded to, but we need our daily stock pick. And I also think you can't have it easy. You gave a really nice tip for a very unknown US stock a couple of months back. So give us one that's not obvious. And what are you looking at the moment, here or offshore?
Oh, wow. To be honest, I haven't bought anything recently. So I have to think a bit carefully, and I always have to think carefully about which ones where I'm going with this. Let me think.
While you think, I'm going to put a plug in, because as I've told you before, you're really bad at this. But Stephán opened the door as well. And as we said, he's head of equity research at Anchor. Please feel free to contact him. Everybody who's on this webinar will get a link to the presentations and a recording, and automatically our CPD allocation will be sent to you. But also engage with Anthea. She mentioned financial advisors, asset managers. Engage with Anthea, whether you represent an institution, whether you're an IFA or a retail client. And if you're the latter, check out Anthea's managed product on some platforms, #invest, because I think Anthea there, you're giving some interesting exposure to people, not necessarily, and it's accessible and it's easy. But that's given you enough time to think and give us how we're going to make money in the next month.
Carl, I'm so torn about this giving you a stock pick. I really am. And I'm very nervous about the market at the moment. Like, I spent most of yesterday looking how the JSE has bounced back to this kind of pre-COVID level. And yet, you know, people are losing jobs. There's no tax revenue coming into the country. So I'm going to go for a really boring, safe bet today. I'm going to say go buy some Naspers shares.
No, but I think, Anthea, that's a good point. I mean, it's also, the time is not necessarily always right to invest. You know, there is a time to hold back and do some more research. I think that is a good point. So big thanks to you and Stephán. We spoke about a lot more than just shorts and shorting, but I think you guys explained a difficult topic really well. And these webinars, the feedback we get is it's a good balance between some novice investors. We've mentioned some of our regular listeners before, Derek Christian, for instance, who now, since he's retired, is taking an active interest in his own portfolio. We've got Kobus Klein and other financial advisors. So it's a real mix, Anthea, and I really appreciate you taking the time, inviting interesting people like Stephán, who clearly are passionate about what they do and helping us understand the markets better. Yeah, thank you, Stephán. Good luck with your reading today. Are you going to show us if you're wearing short shorts, or what did Anthea brief you on?
Well, I don't think I'm going to stand up. Sorry.
Good. Anthea, final word to you, please.
Right, I think today was a fairly technical, difficult webinar to kind of get your head around. So thank you, everybody. I see everybody stayed until the end. And I think next time we're going to go for an easier topic and maybe talk about offshore investing. How's that?
Sounds great. Look forward to it, and we'll share details with everybody. Have a good afternoon. Cheers.
Bye.